Netwealth and Income Asset Management Group have partnered to provide financial advisors with direct access to small parcels of bonds through the Netwealth investment platform. Jenna Labib from Income Asset Management joins me now so we can discuss more details around this deal. Jenna, thank you so much for coming in.
Thanks for having me, Danny.
Okay, let's break this down because you and I have just been having a great chat about this new deal. So basically, what's Income Asset Management bringing to the Netwealth platform?
Perfect. So historically, using Netwealth, investors could purchase bonds in parcels of 500k, which is quite large for an individual investor, harder to achieve diversification. Netwealth and IAM's partnership mean that we have access to over 350 bonds that advisors and clients can access in parcels as small as $50,000 to enjoy, the very attractive characteristics of the Australian bond market, which includes reliable income, diversification, just to name a few.
Absolutely. So let's take it back a step and just define, we're talking corporate bonds here. We're not talking Aussie bonds.
Yeah, correct. So when a company wants to issue debt or raise money, then they can issue a bond to the market. A good example is today, Port of Brisbane are in the market. You've seen.
Yes.
So that's a senior secured bond with a maturity date in 7 years' time, and the price guidance is 6.5%. And so that's the kind of bond that clients using the Netwealth platform now have access to. And the great thing is there's been a whole raft of new issuances of late, which you might have seen. Last week, Commonwealth Bank came to the market with a fixed and floating rate 5-year callable subordinated note. And the very interesting thing about that one was the fixed coupon priced at 6.446%. And the franked dividend for CBA is about 6.3%.
Yeah.
So, it's actually higher yielding and higher in the capital stack. So you're getting, more efficient yield per unit of risk.
Yeah, it's quite interesting because it might say something about what investors are thinking around the sustainability of the franked dividend. But let's not go there. Diverging. Okay, so for investors that maybe aren't across corporate bonds and what they're offering, I guess the question is how are they different for the investor buying them directly through the Netwealth platform versus buying through a bond fund or an ETF?
Okay, so there's a few benefits or differences between buying directly or indirectly. I'd say the first one would probably be control. So, with buying direct investments, you will know the same way that with equities, you'll know I hold BHP, Macquarie and Woolworths. With direct bond investment, then clients can choose exactly which companies that they invest in, know which bonds to include in their portfolio. Whereas with managed funds, oftentimes they might only divulge their top 10 investments. So it's a lot harder to know exactly what you own. And I certainly think that that's a trend that we've seen over the last couple of years with investors really wanting to know exactly what they're invested in. Another difference would be with direct bond investment, you have the certainty of a maturity date.
Yeah.
So, regardless of where the bond's price trades during its tenor, investors are aware that at the scheduled maturity date, the price will be redeemed at a price of 100. Another benefit would be, or maybe difference rather than benefit, would be that, with bonds, they're based on future returns. So when you buy a bond, its interest payment dates, and so you can say with a reasonable degree of certainty what your bond portfolio will return over its life, whereas, with a managed fund, it's usually more based on historical performance. So I'd say similar to with equities, the decision to go directly or indirectly both have different benefits. So it really comes down to the individual.
Absolutely. So you launched on October the 1st. What sort of flow of funds have you seen into the products?
We've seen, amazing take up, which really points towards this having been an advisor-led demand. So, with Netwealth over the last couple of years, and certainly I think it's escalated over the past couple of months, that advisors have been coming to them saying, our clients are wanting access to direct bonds. And so, as someone in their sales team, for IAM usually being the one making calls, it's been quite a welcome change that I'm having Netwealth advisors calling and saying, I've heard that we went live. How do I access the platform? What bonds do you offer? And as I mentioned, there's been a whole suite of new issuance of late if people want to participate in primary transactions. I mentioned the CBA last week, but if people are overweight financials, there's also been a lot of corporate issuance. There's been, WestConnex, Woolworths, NBN over the last month. Oh yeah, you participated in a few. Port of Brisbane today, Transurban Queensland expected this week. And so definitely a lot of, opportunities for people to get invested. And the great thing is, a lot of the issuance, I mentioned the Port of Brisbane and Transurban, that's infrastructure. And that's certainly a sector that investors like exposure to during, heightened periods of volatility.
I'm going to have to confess now, Jenna, the Akuye Self-Managed Super Fund has been at the corporate bond trough, drinking everything up recently. Now, I guess that begs the question, why are people like myself so keen to be buying corporate bonds at this point in the cycle?
It's really as we've had this rise in interest rates that the yields on Australian corporate bonds have adjusted and are now offering those very attractive returns. So historically, people, thought about bonds as, the low risk defensive part of their portfolio. That hasn't changed, but what has is the yield. And so when you do have that low risk defensive part of your portfolio that's yielding north of 6%, as it is now, with investment grade credit, and will have a lower volatility than equities, that really is the sweet spot for a lot of clients. And I think in this environment, the main event of this week was the quarterly CPI print that just came out this morning. And again, inflation, it was higher than forecast. And so I think with those inflation concerns, it's spurring a lot of Australian investors towards more secure investments. There was also, you might have seen the ASX investor study. It came out a couple of months ago. It was the first one since, I think, 2020. So it kind of encapsulated the post-COVID pandemic trends. And it really showed a shift in investors towards more stability. An increase of 17% in high net worth individuals that are choosing to invest for guaranteed returns. And although you would know that bonds are not government guaranteed, they are, a contractual obligation by the issuer of the bond to pay you your interest along the way and your principal back at maturity.
Absolutely, and probably worth highlighting that they do rank higher normally than equity in a worst case scenario. Is that not the case?
That's exactly right. And, there are many examples of the capital stack in play during the GFC. If you look at CBA and a few of their different instruments, the CBA equity fell to from 100 to about 50. The bond...
Are those the hybrids you're referring to?
That was equity, but the hybrid, went down to about 70.
Yeah.
Whereas a CBA senior bond, still stayed around that 100 and actually went up a little bit in value, just showing that, inverse relationship between bonds and equities during normal market conditions. Of course, that inverse correlation or negative correlation did not play out during COVID when we had the combination of rising interest rates and skyrocketing inflation. But we do think that going forward, we should see that relationship continue.
Yeah, really, really good points. Do you think there has been, as you've just highlighted, a suite of corporates coming to the market recently? It's interesting because some of them are fixed, some of them are floating rate. Do you think this is just the natural pathway of rolling over their debt, or they're coming to the market at this point in time because they're concerned that the cost of finance could be shifting up?
I think you're right, because it really has been a very big flurry recently. And so, if I look at it, I think, one, it could be uncertainty in the Middle East that is, prompting a lot of companies to decide to lock in debt now. Also, given we spoke about the hot CPI print as well as recent more hawkish rhetoric from the RBA, that very much suggests that the 7th of November meeting is a live meeting. So they might want to lock in their funding before that. And then as well as that, with the banks, they are always regular issues of Tier 2 and will need to continue to do so to meet their TLAC requirements. So it's, a very good opportunity for clients to take part in both the secondary market, but also primary, when as you get a little bit of new issue premium.
Absolutely. And just really briefly, just explain the secondary market for those that don't understand it.
Good point. So the primary market, similar to an IPO for equities, it's when a bond is issued for the very first time. The secondary market is bonds that are already are trading post-settlement in the market. And so when a company comes to the market in primary, they might want to raise a lot of money, and so they want to incentivize clients to participate in that shiny new bond deal by paying a bit of, what we call new issue premium.
Yeah, and so in the secondary market, depending on where the cash rate, where bond yields, as in government bond yields, go, you sometimes see some movement, don't you, around the price. And maybe just again, really briefly, just touch on the mechanics, because unlike Europe, Australians are not necessarily, or America, fully au fait with the pricing mechanisms, how they relate to yield.
Exactly right. Not everyone is as sophisticated as the Akuya super funds.
Hardly.
So bonds are typically issued at 100, redeemed at 100, and between issuance and redemption, they can trade above or below 100. Bonds price and yield have an inverse relationship. So I spoke about the recently issued CBA 6.449% bond. That will pay a 6.449% coupon every year via 2 semi-annual coupons. That coupon will not change. However, if we do see that yields continue to move higher, then that bond will actually go down in price. And so if you need to sell along the way, then you'd be crystallizing a loss on that instrument. The inverse is also true.
Exactly. Jenna, thank you so much. Congratulations on the deal, and I'm sure you'll have a few people racing off to the Netwealth platform to see how they can bag a corporate bond bargain.
Thanks very much, Danny.
Okay.